Buenas tardes y bienvenido. Good afternoon and welcome to our first international webinar of the season. Today we are partnering up with ASCRI, our friends in Spain, and who helped us to create this event of the day. This webinar will be split in two. The first part will be a legal and regulatory update delivered by Isabel from KWM and also Jerome from Elvinger Hoss. They will talk about structuring EU initiatives, cross-border distribution directive, and also AML. So lots of interesting topics which could be of interest for our Spanish and also Luxembourgish friends. The second part will be the panel. This one will be on the impact of the EU recovery plan in private equity. There we have Anya from TMF as moderator. We'll also have Christine from EIF, Klaus from SwanCap, who is also our president, and Juan Luis from Portobello Capital. Concerning the EU recovery plan, this has been defined as a budget for 2021 until 2027, long-term budget of around 1 trillion, also some COVID-19 safety nets around 450 billion, and also then this next generation EU funds, and then also recovery package will be around 750 billion. So lots of money to help out the different companies, sectors, and certainly also states in the EU, which is a good step. I mean, they will also focus on sustainable finance for sure and digitalization. But we will all be hearing that in more detail thanks to our panel. Now, just before I pass over to Aquilino from ASCRI, just wanted to highlight that we like interactive sessions, so don't hesitate to use the chat function or the Q&A button in order to ask your questions. So now I will pass over to Aquilino, and it's a pleasure to host you today.
Well, thanks very much, Stefan, for the kind intro and for partnering with us on something which is a very hot topic today in all the discussions that we are having, which is how this large inflow of capital that the EU is producing into the member states and across all our economies are going to affect investors, fund managers, and portfolio companies. So this is a really hot topic. And from ASCRI, we believe that in this context, investors in both private equity and venture capital, we are part of the solution to the deep crisis that we are suffering in our countries, and that we have the tools, the know-how, the dry power, and the right incentives to make sure that all this investment pool is funneled through the economy in a reasonable way. Providing both the objectives that these EU plans have on the economies while producing new opportunities and returns for our investors. So today we are going to showcase, as you mentioned, as Stefan mentioned, two different aspects of this. One is the legal aspect with Isabel and Jerome. Thanks very much for participating, and then the panel with Christine, Klaus, and Juan Luis. So again, thank you everyone for participating, and thanks to our friends at the Luxembourg Private Equity Association, which for the second time are producing this type of seminars. Too bad we cannot be at the Villa Magna in Madrid or at other same nice venue as we did 3 years ago, but we hope to for the next year to do something very similar either in Luxembourg or in Spain. So thank you all, and hope that all the participants and attendees, we have over 110 people attending this webinar. So hope you enjoyed and get some good learnings. And again, thank you to the Luxembourg Private Equity Association. Stefan, thanks for doing this with us, and enjoy it.
Thanks a lot, Aquilino, for your kind words. And it's always a pleasure to work together and to create hopefully very interesting webinars in the future too. So now I will pass over to Isabel and Jerome. Thank you. And for them then to update us then on all the legal and regulatory topics. The screen is yours.
Okay, hello. Thank you very much to your associations for giving us this opportunity to participate. Good afternoon, everyone. I'm Isabel Rodriguez from Kenwood Mallesons in Madrid, and it's a pleasure for me to share this panel with my colleague Jerome, and we hope that you enjoy this part of the session today. To you, Jerome.
Thank you, Isabella. I'm Jérôme Vigny. I'm a partner with a law firm in Luxembourg called Elvinger Hoss, and I'm also delighted to be present with you today. I think we will start, as Stefan was saying, with a few words about the latest trends in fund structuring, and Isabel might give the Spanish view. I will give the Luxembourg view thereafter.
Yes, thank you. There is one option that we always consider for our clients when we face the structuring of a new project. And although most of our funds are structured using Spanish structures, it is also true that every time we just decide to look for another jurisdiction, we normally turn to Luxembourg. The reason for that is just the huge flexibility that the jurisdiction offers in all terms. I mean, it's just something like a little joke saying that whatever you need, Luxembourg has it. And it is true. I mean, it's a very, as I said, flexible jurisdiction that is able to accommodate many of the players in the market needs. So sometimes we struggle a little bit with certain regulatory issues in our country, or it's just a simple commercial issue coming from limited partners when it comes to fundraising, and that's the reason why we consider always Luxembourg as one of the most relevant options for us. Today, I would say that the ones we have the limited partnership, the Luxembourg limited partnership in place, the ASCRI, together with the RIFE regime, I would actually say that this is the structure that we do use the most. I mean, the RIFE regulatory regime is very useful, it's very handy, and it saves a lot of time in terms of registration and authorization, which is no more needed from the CSSF as long as you've got a full regulated manager. So when it comes to the structure, to the legal structure itself, when we go to Luxembourg, as I said before, there are several options that can fit the SEF, the SCA, the limited partnership, as I mentioned before. And so it's just to decide on a case by case, depending on the project, where the investments are going to be based, where the investors are based as well, and then whether you may need a tax transparent vehicle or not. In this respect, and this is more related to the limited partnership. With the tax transparency, and this is just bringing a little bit the Spanish angle, it's just good to mention that sometimes when it comes to investments in Spain, if the fund is going to invest mainly in Spain, we may face some issues with tax transparency, as I mentioned before, because the manager may need to require all the investors in the fund to give their own tax residence certificate, because for the purposes of Spain, the LPEA is tax transparent. It's not a big deal, it's not a problem, but it could be a little bit cumbersome for the managers in that respect. Having said that, as I said before, it's flexible. There is a huge diversity of vehicles that can fit, I would say, pretty much all needs. And these are, from my perspective, the ones that are most used when it comes to Spanish managers that either activate their passport or they hire the services of a Luxembourg regulated manager.
Thank you. On my side, I'd like to mention the fact that the private equity scene is extremely dynamic currently. The growth comes, of course, from the fact that in general, there is a lot of appetite in non-traditional asset classes, including private equity. The trend is driven by the US houses. What is new is that the very large US houses currently tend to systematically do a Luxembourg fund in addition to a main fund that usually remains in the Cayman Islands or in Delaware. Sometimes when the underlying assets are in Europe, then they would even create a Luxembourg fund instead of a fund in the Cayman Islands or in Delaware. The reason is mainly investor appetite. So of course, the Luxembourg fund allows them to have a passport and to reach out investors in jurisdictions where it is more difficult to reach them out with a private placement. But It is more often to do with existing investors that prefer investing in a European fund, or have less constraints to invest into a European fund. Those managers that have disclosed the figures show that they have raised significantly more money in Europe through a European fund. There's also a side effect, is that a number of European private banks, whether they're Swiss or Spanish or else, need to create performance for their private bank clients. And they achieve that by pooling their clients into vehicles that give them access to Apollo, Blackstone, Carlyle, etc. And that is facilitated by the fact that those managers now have a European fund to offer. Finally, on the Spanish side, as Isabel was saying, indeed, like many Europeans, most houses prefer a corporate fund, and therefore the vehicle of choice is normally a corporate RAIF. But because the US houses prefer partnerships, because that is what is the closest to what they set up in the Cayman Islands or in Delaware, we start seeing a trend of just repeating the same thing. We see that more European investors are used to investing in partnerships. It has its challenges, as Isabel was saying, in particular the tax transparency, but it has also its merits. And so that is clearly something we also see from Spanish promoters that are moving from corporate structures to partnerships. Isabel, I believe you're going to say a few words about a number of European initiatives.
Yeah, I won't get into much detail because obviously this is hugely cumbersome, but we decided that it could be good for you to at least hear, I mean, a little bit about what are the challenges, the regulatory and legal challenges that I think the sector is facing for this year, although maybe not all of them will be in place this year. But you know, the new initiatives in regulation refer basically to solvency. We've got also MiFID II, the regulation that you may know nowadays related to ESG, which we are not discussing today because, you know, the regulation enters into force today as we speak. So probably you have heard a lot about that. And so we won't get into this today. But again, it's just something that will need adjustments during the course of the year. Then we've got the review of the LTIF regime, one way or the other hasn't really, you know, hasn't really been proven to be as useful as it was expected initially. So it's another regime which is under review. And then the two main points on which we will be discussing today, which is the review of the Alternative Investment Fund Managers Directive, which is probably the regulation that has the highest impact in the sector, and then the directive related to cross-border distribution, which is also as well at everybody's desk and under the discussion. In relation to the directive, as you may know, the European Commission has just issued a consultation paper, which is the first step for the legal amendment, which is expected to take place during 2021. And one of the, well, there are several issues under consideration and then under review. I would like to point out a little bit about the investor qualification, which is something that from our perspective is being discussed a lot among clients. And basically, as you know, the passport, the directive grants, allows managers to market among professional investors, right? But it is also true that within this business, this market, there are loads of other investors, either high net worth individuals or sophisticated individuals that have, you know, enough knowledge and sophistication to be able to invest in this type of assets. But if they don't fulfill the MiFID requirements, which is what is referred to in the directive, they are automatically categorized as retail investors, and they are not, or at least you can't really say that they are retail investors. This basically leads to a situation where either those investors are prevented to invest into the asset, or the managers that go ahead and take them on board, you know, need to face loads of requirements in terms of internal regulation, disclosure, governance, so on and so forth. And to be honest, it's just a type of protection that this investor doesn't need. So what is on the table right now is the creation of a new category, which is called semi-professional investor. It should be harmonized among the European Union, and it's just something sort of to say in between, right? They are not retail investors, but they won't qualify under MiFID as professional. I mean, it's just, again, as I said, it's under discussion, but we think it's a nice solution because it gives every type of investor the level of protection that they really need, right? So then we've got the directive on cross-border distribution, which I think is a relevant piece of regulation that I think Jerome is going to cover right now.
Yes, and as an introduction, I'll say that it is, again, very typical of the European Union, because this cross-border distribution directive was meant to improve marketing and reduce barriers. At the end of the day, I really don't see what is improved. I'm afraid there are just more constraints and more difficulties. And it's typical because, of course, when you start rediscussing this, the large countries like the systems they've put in place and try to convince the European Commission that it should be expanded. The directive was voted in 2019, and it will be applicable in all member states as of 2nd of August 2021. So that is going to be extremely soon. The directive applies to AIFs, but also to UCITS funds. I will just mention two topics. The first one is the subject of pre-marketing. There have been diverging practices in Europe, but Luxembourg and the UK, which were specifically mentioned when they were discussing that, have always been a bit flexible, because before a manager decides to register a fund for distribution in various European countries and spending the costs of being registered in those countries, it is normal to first feel the waters to see if there's some appetite in Finland or in Hungary or in Spain. And so one could do what is called pre-marketing. Now, it's been accepted, but it's been subject to many conditions. First, there's a definition of pre-marketing. And pre-marketing, again, is that idea that you want to test interest in a given jurisdiction for an AIF before you actually make an offer, because once you make an offer, you need to be registered in that jurisdiction. So the conditions are first that you should not provide information which allows someone to take a commitment. So everything should be in draft form. You cannot provide a subscription form, which makes sense, but you can't even provide documents in final form. So even if you put draft on it, if they're in final form, that would not be pre-marketing, but would be deemed to be marketing. Then, more importantly and painfully, if you want to do pre-marketing, you are to go through a notification process. So it's a regulator to regulator notification process. But if you create a Luxembourg fund and you want to sell it in Germany and you want to do pre-marketing in Germany, you need to notify the Luxembourg regulator that you want to do pre-marketing in Germany. And you have to notify the regulator within 2 weeks of the start of the pre-marketing. So fortunately, it's not a precondition, but you have to say where you want to pre-market, when, and what fund will you be pre-marketing. There's also a requirement that pre-marketing can only be performed by regulated entities. So either MiFID firms, credit institutions, or management companies or AFMs. So for example, it will be a problem for a US manager to pre-market. So the US manager creating a Luxembourg fund will not be able to test the waters in Germany to see if there is appetite or not. And then finally, all this has an impact on reverse solicitation. And that is that if you do feel the waters, so in other words, you notify that you want to do pre-marketing, for example, in Germany, if you receive any subscription from a German individual within 18 months of the pre-marketing, then you're deemed to have been doing marketing. So in other words, if you do pre-marketing, any subscription that comes, even if it's not the person you've spoken to, will be deemed pre-marketing, which is different from today. Today, I think we've always said, that if you pre-market to an investor and that investor subscribes, then you have to register for marketing. But now, if you pre-market to in a jurisdiction to one investor, even if another investor from the same jurisdiction whom you haven't spoken to would want to subscribe, it would amount to marketing, and you need to register the fund. So that obviously is more restrictive. I would also say that these rules apply to European funds with a passport, but it is very likely that each individual member state, and they are encouraged by a recital in the directive, will apply similar rules for funds that would be marketed on the basis of a private placement. So even if you're trying to private place a given fund, you would also need to apply similar procedures. Although that is not entirely clear, it will depend from country to country. Isabel, would you say a word about other requirements of this cross-border directive?
Well, maybe the main impact, as in order not to get into much detail, I would say, further to what you have said, is that now you have the opportunity to discontinue marketing, which was something that wasn't really clear before, and basically, managers that desire to not to continue marketing in a certain jurisdiction, they can do that. Once the certain conditions are fulfilled, and well, obviously they need to offer the purchase or redemption of the units in case the fund was already marketed in there. The intention of terminate the marketing should be public, and then they need to terminate any type of agreements they may have with financial intermediaries or placement agents, so on and so forth, in order to conclude the marketing in there. The main issue with this particular point, and is also under discussion, is that there is a restriction on pre-marketing for successor funds once you have asked for your fund to stop being marketed in that jurisdiction, and it's 36 months. And the point is that this period of time may well be beyond the end of the prior fund's investment period. So it has a real impact on fees, basically, but also in the dynamic of the market. So what happens is just some managers simply just choose not to deregister any funds. So assuming that causes something related to the pre-marketing of the successor fund, right? So I think it's one of the relevant issues that we thought it could be good to raise today for you. I think that could be basically it on cross-border from my side.
But maybe on this last point, Isabel, as you very correctly said, one of the difficulties is, again, if someone markets a fund in Germany and it's not successful, now it was fairly easy just to stop paying the fee in Germany and just saying you had no one. Now, with the new procedure, if you want to stop paying the fee, the danger is that if you want to start marketing the same fund or a similar fund within 3 years, you won't be able to do that, which is particularly painful.
It is very painful. Yeah. There are certain boundaries that are creating a lot of uncertainty in the market for the managers, no doubt.
So should I finish with a few words about the Luxembourg money laundering rules, because that is an important topic for Luxembourg. I will just focus on two types of rules. One, it's about the formalization of the money laundering, anti-money laundering framework, and the second one is AML on assets. On the formalization, it has much to do with the fact that FATF will be visiting Luxembourg this year. We still feel that our money laundering framework is particularly robust, and the funny part is that those who use Luxembourg usually acknowledge that Luxembourg is demanding in terms of AML KYC. But it could indeed be better formalized, which is what we've tried to do. So first, there is a clear requirement now to have for each fund a money laundering policy and an anti-money, an AML appetite document. So you have to say what kind of risks, what kind of clients, what kind of activities are you willing to to pursue, and an AML risk assessment. So regularly you have to assess whether the risk that you've taken is in line with the risk appetites that you declared you would be taking. So that's about policies, also identifying who should be doing what, which is often helpful between a management company or a transfer agent, for example, when it comes to doing due diligences on intermediaries. And then the other formalization is really having 3 layers involved in money laundering verifications. The first one is the obvious one, is the delegated provider, usually the transfer agent or the management company. They are usually the ones who do the groundwork. But then at the level of each fund, we have decided that the board of directors or an individual at the level of the board should be involved. And for example, in approving high risk relationships, if you have to admit a politically exposed person or appoint a distributor in a high risk country or medium risk country. So you really want the board to be involved or an individual within the board. And then, and that is new, we also want a permanent resource that will be involved in supervising money laundering on an ongoing basis. It could again be a board member, but typically it is a delegate of the board, often an individual in charge of compliance or money laundering at the level of the AFM or the management company. And that person is really the day-to-day person liaising with the transfer agent, with the management company, with the board, producing reports and facilitating the work for the board. And then in addition to that formalization, the other aspect that is new is, and there I think Luxembourg and France are trying to be a bit ahead of the game. It is to perform a form of AML on assets. And it's a form of due diligence on assets. In private equity, for example, it's often done, real estate as well, but this is broad. And of course, the duties that you need to be performed will very much depend on the relevant asset class. You don't do the same type of work if it's private equity than if you're investing in listed securities. But the minimum is really to be screening names against sanctions lists. And that, whether it's listed securities or not, you need to screen the names of directors of counterparties, the directors and shareholders of investee companies, etc. It is a lot of work. What we see is that an amount of work was already done in general by the industry, but slowly everyone needs to improve, and in particular ensure that not only those verifications are performed, but it goes up to the management company, the AFM, and to the fund board. So in other words, it's really, for example, for the deal teams to add sections about in the due diligence about money laundering of counterparties or target entities, and to convey the information to the management company and the board. So it is nothing very new, but indeed it gives the impression of a strengthening of the AML framework because of its formalization.
Thank you, Isabelle and Jerome, for this update. The audience, now is the time to address your questions. We already received one via the Q&A. So the first one is, what is driving those more complicated marketing rules?
Well, I mean, I don't think that the regulator think that it are more complicated. They can be, because every time they change, they seem complicated. It is true that all this issue about marketing, in essence, tries to give us an homogeneous framework within the European Union that wasn't really achieved by publishing the directive. And as Jerome says, it also covers usage. So it's just like a wider framework on how this operates among the European Union. I mean, are they more complicated? They are somehow, and but in other points, it is good to know, you know, what are you facing when marketing across the European Union, rather than going country by country with, you know, complete different rules. No matter what, we've got the directive in place. I don't know, Jerome, if you want to add something here, but that's my view.
It's a very personal view, but I'm afraid it has to do with the fact that ultimately a lot of money that is raised in the EU is not done through the passports or the private placements. So in other words, the very large managers have existing clients in the EU that continue to subscribe. And I think the lawmakers feel that indeed it would be beneficial to force all this new money that is flowing into new funds to fall under the one or the other procedure, either the passport or the private placement. And so it is in a way closing the door to pre-marketing, or making it more difficult, to reverse solicitation, at least making it more difficult, in order to favor the passport or the private placement.
Great. Thanks a lot for this extra explanation. So if there are no more questions, we would like to thank then Isabel and Jerome for their insights again, and for being with us today. So thanks again. And
thank you.
Let's move on then to the panel, which will be moderated by Anja. As quickly highlighted before, this is the EU recovery plan for the next 7 years. So there are still some details to clarify, but we will try then with this panel to give you at least the different available news and information already there. So Anja, the screen is yours again.
Yes, welcome also from my side to everybody. I think after this gloomy outlook on the cross-border directive, I hope we can sort of cheer you up a little bit. This panel, as Stefan was saying, is about something which is not sort of 100% sort of laid out. It was just started that piece of legislation last year, and you probably still remember that in 2020 there were the 4 countries that were sort of against the rest of the EU on the new regulation, and then eventually in July it still sort of went through. It's definitely sort of one of the major sort of milestones of the EU going forward, because contrary to what it says, it's not just about the pandemic and trying to repair the damage that the pandemic is still doing today, but it's also about changing the economies of the EU with a very high focus on green energies, for example, on digital transformation, etc., etc. So it's going to have an impact for the next years. The speakers that I will have, Christine Panier from the EIF is going to present to you in more detail what this actually is all about, as well as the time frame that we are talking about. And then we have Juan Luis Ramirez from Portobello capital in Spain, who is at the same time the president of ASCRI, as well as Klaus Mansfeld, who is the managing director of Swan Cup here in Luxembourg, but also the president of the LPEA. So I think in this case, more with your PE hat, we'll have a look at how this is going to translate into private equity, what the impacts are going to be that the plan has on private equity on a, let's say, national, but also on a European basis. So if it's pro or con, and we'll see sort of what that is going to give. So let me pass on that relay to Christine, who's going to give you, first of all, an update sort of what it all covers, and again, sort of what the time frame is. Christine, you're muted. Christine?
Yes, sorry for that.
Yes.
Thank you, Anya. So I will now explain a little bit more in detail what these programs are, and especially trying to illustrate what Anya just said about the main objectives which are on this program. So if you can see my slide desk now, I think it should be available to you. So to set up the scene a little bit, what is the recovery plan for Europe? As it was announced in December 2020, it's a program which has been discussed and agreed between European Parliament, European Commission, and EU leaders. It's a 1.8 trillion program, which is meant to lead the way out of the crisis. Obviously, this is the most important immediately. But as Anya said, it's also meant to lay the foundations for a more modern and more sustainable Europe. So 2 elements in the program, the multi-annual financial framework, 2021 to 2027. So it's a bit of the, let's say, the long-term part of the program, which is 1.07 trillion. And the next generation EU, which is more specific to the current crisis we are talking about, out of which the recovery and resilience facility is the most important for 673 billion euros. And I will concentrate now on this one because, as I said, it's the most specific part of the program and also the most advanced program. So the policy objectives of the recovery and resilience facility are manifold. So I think the most important to remember is that it will be implemented by the member states. So the EU will obviously give the money to the member states. So, but everything will happen at the member states. So it's not a central program. It's really a program which is tailor-made by each and every member state for itself. It will provide large-scale financing to support public investments and reforms and accelerate the recovery, but also make the member states' economies more resilient. So it's hence the name of recovery, but also resilience. I think it's also a very important feature of the program. So it will focus on reforms and investments, fostering the green and digital transition. We'll see that more in detail later. It's also aimed to reduce economic and social divergences in the Union. So again, to try and make the countries which have been more hit by COVID and also which need more support to get this support from the EU. It will be financed by the European Union Recovery Instrument, which is a specific instrument which has been put in place for this to be able for the EU to collect the money. It will complement obviously other EU initiatives, and it will also temporarily adapt the European semester, which is a dialogue which happens between the different member states and the EU regularly. So this will be part of the European semester consultation. Just to set up the general features of the facility, it will be paid in installments upon fulfillment of milestones and targets. So it's not some money which will flow directly to the member states and nothing will happen afterwards in terms of targets and milestones. It will include, as I said before, reforms and investments for the subsequent years. So it's a short-term program, but it's also meant to cater for mid-term objectives. So up to mid-2026. And the member states will submit their program by 30th of April. They could submit it already since October, I think, but they have to submit it by 30th of April. And they will also submit an updated plan after July 2022. So 2 parts of this program, one is grants and one is loans. So the grants are 300 billion euros. They will lead to investments and reforms up to 2026. And the deadline for commitment is 70% of the maximum allocation should be available in 2021 and 22, and 30% will be allocated after 2023. So again, to cater for short term, but also mid-term. And there will be a pre-financing of up to 13% to be approved in 2021. So very short term, 13% of this program should be approved and pre-financed. On the loans part, it's 360 billion, so slightly larger than the grants. The request will be will have to happen until 31st of August 2023. And it will be have to be justified, obviously, by higher financial needs linked to additional reforms and investments which have to be made currently due to Corona or due to any situation induced by Corona. And the loans are capped at 6.3% of 2019 GNI. So the cap of on these loans can be increased in exceptional circumstances. Just to show you, not to enter into details on this slide, but just to show you the cycle which will happen. So first, the member states will have to apply for by 30th of April. And then there will be a review by the Commission and by the Council as well. And the Commission will, in the end, pay 13% of the total support upfront to kickstart the recovery. So, as I said, it's meant to happen 5 months after 30th of April. So it's still in 2021. So a short-term period of disbursements. And then up to twice a year, the member state will request further disbursements above this 13% upon agreed milestones and targets, which have to be included in the program from scratch. And then the Commission will afterwards prepare an assessment, and also there will be sometimes committees to consult for the member state to confirm that the program has been implemented according to targets. What will happen at the level of the member states? So the criteria which will have to be applied for the member states to get this program, the investments will represent a balanced response to the economic and social situation of the member state. So it has been to be justified by the member state itself according to its own situation and objectives. And it will effectively address the challenges identified. Also, the EU makes regularly country-specific recommendations. So these recommendations will also have to be part of the proposal of the member states. And it will have to strengthen the growth potential, the job creation, and the resilience of the member states. And even more important, there will be a target for climate objective. 37% of the program should be dedicated at least to the climate objectives, and 20% for digital objectives. So it's not only to help the member states to overcome a situation which might be linked to COVID, but it's also meant to provide modernization, so to say, in a large sense, with climate objectives and digital objectives for each member state. Last but not least, the program which is proposed by the member states shouldn't significantly harm any of the environmental objectives of the EU, which are well known, which are climate change mitigation, climate change adaptation, transition to circular economy, etc. So this is also, there is also a willingness that these measures, which might be urgent and which might be very important for the economy, still do not harm any environmental objective of the EU. So just at the end of the presentation, obviously everything comes from the Commission. So I've put 2 links, which are the regulation itself and also the summary of the recovery plan for people who might be interested in knowing more about this program. So this ends my presentation. If you have questions, obviously we can answer them at the end of the panel. My conclusion would be, as I said, that what is important to remember about that is that it's a recovery plan, it's a resilience plan. So it has short and mid-term objectives, but it's also a plan which will also help the different member states to modernize themselves, and especially in the digital and environmental space. Thank you.
Okay, thanks. I think that was a very good introduction into the topic. What we are not going to discuss here, sort of what the impact is going to be sort of on each country's budget and taxation over the next couple of years. But I think the the plan actually leaves room for two different, let's say, streams of discussion. One being the impact that the industries are going to have, renewable energies, the cyber changes, a lot of sort of new work that has normally been done only by sort of venture capital to a certain extent, and I think there is still a lot of room for future companies sort of to grow, for startups on the one side, and on the other side, obviously, is how is this going to trigger down? For the moment, we are at the stage where there is the European plan, and it's going to be put into local country or sort of national plans. So the question for me would obviously be how is this money going to flow downwards? And is that money going to be called? Are there already plans on a practical basis where, let's say, the governments are actually going to assess how and to whom that funding should go? So, for example, the private equity industry obviously is the industry that is driving also and supporting changes with smaller companies, venture capital funds, private equity funds. Is that money going to arrive actually on that level as well? Or who is deciding on a national level where the money is actually going to go to? And coupled with that question, since the EIF, and that's sort of shooting that back to Christine, basically, since the EIF has always been the key investor in venture capital funds, in particular here in the EU, how is the EIF going to get access to that budget? Will you have to ask for a budget which is then allocated to the funds, and the funds have to apply for funding from the EIF? How is that going to work in practice, Christine?
So I'll try to answer something which is not more confusing for the people, but I would say what we were just talking about, which is the recovery and resilience facility, is as you have seen, is grants which are not private equity, or loans which are also not supposed to be private equity. Where private equity is acting in this program, and especially where EIF is acting in this program, is twofold. The first one in timing is something which was not the subject of today, which is the Pan-EU Guarantee Fund. As the name doesn't say clearly, there is a large part of equity in this program, and this equity part is actually managed by EIF mainly. And this is meant to be invested directly in funds. So we act as usual as fund of funds, and this program is meant to be invested directly in funds. So, for example, there is what we call the target fund size facility, and this one is we use to help funds which have made the first closing but are not yet at target fund size. Due to COVID, because some investors might have retrieved, or because they have to accelerate their fundraising, etc. So, for example, this one, but it's a different program, is currently undergoing, and it's a call for interest which has been published by EIF. It's Venture Admin Market. And this one is supposed to be closed by end of 2021. So this is a short-term program. And we are currently starting investing this program, and we have received, of course, many applications for this program. And the next one, which is, so to say, after the recovery and the resilience facility, which is what I showed in the beginning, which is the multi-financial program, which is this famous 1.07 billion. This one is a 7-year program, and on this one, the previous one, which was 2013-2020, was also geared towards private equity as well. Not, of course, all, but a very significant part was geared to private equity, and it is supposed to happen this year again. So we'll have a new equity program, which will derive from these 2021-2027 2027 program, and this one will probably be announced, I would say, second half of 2021.
Mm-hmm. Question maybe to Juan Luis and to Klaus. Assuming that we are not talking about sort of venture capital as such, but we are also talking about companies that need to be developed further to make it sort of more green, more sustainable going forward in the future. And I guess this happens also to a lot of existing companies, mid-sized companies, but also probably sort of the larger ones. Let's say the companies that are already sort of outside their cradle stage, and that would be the ones that would have access also to support from the EIF. How would you go ahead when you invest in those companies? Would you be applying for additional funding from these credit facilities to support the changes in your target companies? How would you translate that in practice? I mean, the objective obviously is that the private equity funds also benefit from that, but to drive the change towards more sustainability.
Okay, should I start? So good afternoon. Thank you very much. Well, I'm not the chairman, unfortunately, of the Spanish Association. I finished my mandate some years ago. I am a founding partner of Portobello, and we invest in the middle market, in middle market companies. And yes, there are some companies in which we are calling for some long-term loans and kind of prefer equity or prefer debt in order to stabilize them for those that had suffered more because of COVID. During closures, we have hotels, we have dental clinics, we have catering for catering services and those. But I'm not sure if they are applying for local monies given by the government in Spain by an entity which is called CEPI, or this has a link probably into the current budget with part of these grants and financing from Europe. But on top of that, which obviously we would make good use, I think that there is still some uncertainties of how these monies are going to be distributed. So both loans and grants. I've heard that 50% would be done through the central government, 50% would go, the other 50% would go on a more local basis by the counties and cities. From the association and from the sector in private equity, we are claiming that we should have a say on the way we could address part of those funds into the middle market, into the SMEs especially, because we've proven that private equity is able to arrive or get where traditional financing is not getting. So we are, well, in Spain, we have now 2,600 companies, most of them small and medium-sized enterprises with more than 500,000 employees. Also, we've demonstrated with a very successful program that we have had with this Fondico, which is a fund of funds, a public fund of funds in Spain that has helped the sector to develop, given that we have very little monies from pension funds and other institutional investors locally. And we call on the international monies, of course. But this has been demonstrated with these monies from Fondico that we have a multiplier effect on those monies into the companies we invest. And then, and as you were saying, private equity demonstrates that we push innovation, we push digitalization, efficiency in all of our companies. This is a must to create value and create alpha in our companies. ESG, which takes the rest of what this program is about. ESG is a reality, and we all are very concerned. We do due diligence on ESG, we improve, we have our semestral reports. So we make sure that all our companies improve in that sense. And then also it's demonstrated that private equity is much more effective. And we've done at least 3 times a big work advised by one of these big 4 companies in order to demonstrate that companies invested by the private equity grow much more. They generate more jobs. They are more profitable, so they pay more taxes. And this is something that would be, we should press and claim to the government that as they have done with Fondico, we should have a say on how these flows are distributed into the enterprises, the small and medium-sized enterprises, which would be, well, in Spain, you know that this is like 80% of our economy, and I hope that, and we have had some contacts with people now in the government. I hope that we would get a piece of distribution rights of those monies in order to be much more effective and clear.
Just a question to power to everybody. If you, I mean, this is me probably sort of who is always having that impression that once money is granted by the EU, now whether that's through a grant or a loan or whichever sort of type of financing, you always hear horror stories of money sort of disappearing into certain channels on the way to projects which don't exist or have existed sort of years ago but are not there anymore. Is it a risk that on the one side, probably not the venture capital firms, sort of the startup firms, but medium-sized companies, PMEs, and also sort of larger ones would be able to apply for subsidies or for grants or loan on the one side, and because they are able to access financing easier, would actually sort of take away these companies from the market as a target company for private equity funds to acquire. So meaning that those companies wouldn't be available anymore to be acquired by private equity funds, who would then obviously sort of do more than just financing them, but hopefully sort of also sort of accompany their growth and or turn around, sort of depending on sort of what the stage is and how bad it was after COVID. Is that not sort of something like a competition scenario somehow between what private equity firms will be doing on the one side and what the objective of the EU regulation here is? Or you think it's not competitive, but both can actually coexist and actually sort of form a symbiosis going forward?
If I can just provide a very high-level answer and then leave the floor to somebody else, but I would say in practice, private equity, I think a good company is anyway finding financings because the banks are willing to finance them and they can find many sources of finance. But what a company which has a private equity player, when they reach out to private equity player, is because they look for something else. They don't look only for money. They look for money, obviously, but not only for money. And I think what a private equity player brings is much more important than just the financing. It's also helping being a sparring partner for the manager, helping to recruit additional managers, giving confidence to the people in the company so that they can recruit better people, providing internationalization possibilities. So in the end, I think it's not too much a question of competition. It's definitely a question of this money going to the right place. And in that respect, private equity can obviously help because I think the Commission is willing to have the maximum control to avoid what you said, that the money flows somewhere when it shouldn't flow. But I think it's all about choosing the channels for distributing this money. And I think private equity is obviously, due to the ESG attention, due to the selectivity of the projects, etc. Obviously, private equity can only help in that respect.
Yeah, Anja, if I may add,
Yes,
So I'm Klaus Manson from SwanCap. We're a fund a bit like the EIF, but we only invest in the best ones. We don't have to invest in all of them. Oh, sorry, Christine. Complementary, and this is the point, perhaps, right? So private equity to private equity, this will be very complementary, and it won't crowd out private equity activity. And just anecdotally watching the COVID crisis and the lockdowns and how all the sort of the GPs acted, you know, when the lockdown really hit, and what did they do with their portfolio companies and so on. And it was, you know, it goes to basically efficiency of decision making, and that's something we always argued that is the advantage of private equity, because they have concentrated decision making, quick decision making, and we hope rational decision making, right? And so it was rational to conserve money. So you know, one of the first steps we observed across the board was this scramble to conserve money as quickly as possible, to draw available credit lines to the degree they were available, and to apply for any eligible grants or support schemes or subsidized lending or anything else possible. But, you know, it's not as if these companies then decided to go on eternal life support, you know, because everybody knows this is temporary and it's whatever is available. And what we noticed, to some surprise, is already in Q2 2020, how the companies and the managements, you know, or the GPs and the managements of the companies were already on the front foot, looking at acquisitions and expansion, you know, at the moment when perhaps, you know, they could see the opportunity ahead. So my point is, you know, reiterating perhaps what Jean-Louis, you know, sees at the front line as a GP, and we see a little bit further back, is nevertheless the efficiencies in our system are very large. And you know, there are lots of statistics out there, you know, also published by our Pan-European Union, Invest Europe, which has demonstrated that private equity job growth, for example, was running at some 5.5% in a survey period of 2 years, versus the EU average job growth of 1.1%. So it sort of shows on many ancillary levels how private equity is just a very efficient way of actually implementing and deploying capital, whichever form it comes at. And I think, you know, the effect this will have is perversely, in a way, and the funny thing about these large fiscal and monetary programs is that the effect is already there, right? Simply by making the announcement, you know, it's almost like the Mario Draghi, you know, Super Mario saving the euro, and by whatever it takes. This kind of announcement on the fiscal side, you know, will do whatever it takes to get capital investments going in Europe again, which are, by the way, at a 15-year low, with or without COVID. And so the only damage would be now, actually, if it's taken away. It's a bit like the Biden plan as well. It's already in the market. It's in the price. So the only damage can be done now is taking it away. So, but overall, it adds confidence. It stables the ship. Sorry, this is very macro, very big picture, but ultimately, this is what's really important, and this is the effect it will have on private equity, let alone the individual actions done by the smaller companies. In drawing on whatever support they can get and making sure they qualify for it. And I think there will be a lot of scrutiny. So they will also be hopefully quite good and diligent about doing that. But you know, it's really the stability of Europe, of the Eurozone. Remember a few years ago how nervous we were about the breakup? You know, now we've all forgotten about it. Maybe in 2 years we will have forgotten about the pandemic, and you say, what? But you know, this is what stability does and recovery does, and the fact that we didn't actually have a complete collapse, and this goes into that. The last point you mentioned is how can we make sure it goes to green, circular, and digital? And I think again, I think regulation should be there to make sure that we don't destroy the planet. But there is also now the forces of capitalism are such that they are now requiring us to follow public opinion in a way, ultimately through the allocations by the trustees of pension funds and whatnot, who are now basically requiring every practitioner to demonstrate, you know, a social and environmental conscience, which goes beyond just issuing a kind of a green report per annum, but actually doing it. And lastly, we have to commend actually the EU for, I think it is today, in fact, by coincidence, that is the deadline for us to all implement
Yes.
declarations and transparency in our live fund documentation, which starts to describe in detail what we are doing in relation to the sustainable, let's say, economy and environment. So yeah, I think these are all interplaying together at the same time. And all the signs are that it'll work well, and private equity will play a big role in let's say, implementing growth.
Mm-hmm. Juan Luis, do you want to comment? If not, I have sort of one or two more questions before we go to the Q&A.
No, I fully agree with all what was said. Christina explains perfectly well how intelligent capital, as I normally try to convince entrepreneurs, we have not only capital, we have intelligent capital that is going to help you to consolidate, to expand internationally, to grow, to be more efficient, to ask for consultants to help you on each of the strategy items that we are going to negotiate together. And the risk of getting tons of money directly driven by too professional entities or professionals, it could be a risk in order to destabilize the system, no? And perhaps could be even a competition for us, no? Whenever you could have a capital for increasing capital in a company for attending to whatever growth needs, this could be on a very cheap way given by whoever in the regional government of whatever place. And this, I think that this should be avoided. And we have as English say, proof is in the pudding, and we've seen how effective is delivering as much as possible through professionals, those monies coming from wherever. So, and I hope that this would be the case, and let's see.
I think there's two things in here, trying to marry what Klaus was saying and what Juan Luis was saying. I mean, for the moment, in particular now, I don't want to say post-COVID, but hopefully sort of soon post-COVID, there's a lot of dry powder out in the market. I mean, it has already been before COVID, and now probably more, because a lot of investors that also would probably sort of foster sort of first-time funds haven't done this because they couldn't meet the teams, etc., etc. So I think we agree that there's a lot of money out there that is awaiting investment. And on the other side, now through the program, there is more access also on the other side through loans and grants. So it's money, a lot of money basically flowing into the market. The question obviously that I'm asking, where is that all supposed to go? Because I think we all have a drain here in Europe, in the majority of the countries, of not having enough sort of startup companies that are being founded to put the money in and to make them grow. But before you can make them grow, you have to found them in the garage in the first place, I guess. So do you think that the fact that, and I think this is going to happen, is that as you were saying, sort of the Draghi effect, that the fact that the program is there already just by the fact that it's been sort of put in place, whether it has really sort of started deploying money is a different story, but that it could also sort of attract money from outside the EU and give comfort, let's say, to an American company sort of to invest in an Italian startup company, which probably they wouldn't have done before because they don't know the Italian market, nor do they have any sort of faith in the Italian market, or let's say the Spanish market or the Portuguese market. I mean, those markets that are basically sort of worst hit by the corona pandemia. So do you think that we'll actually be able to align on the one side this this huge capital inflow that we have, sort of the dry powder on the one side, and on the other side the fact that there are not a lot of companies, which could again then be compensated also by even more money flowing into the European market from outside the EU, just giving, let's say, that confidence that in any case there's going to be backing from the government or the EU sort of as a global entity. So there's a macroeconomic aspect, but there's also a microeconomic aspect. Do you think that because of this macroeconomic sort of confidence that also Klaus was referring to, and on the other side, the dry powder being there, this is going to be brought together sort of somehow and somewhere? There's lots of different ends they are supposed to sort of come together, and I'm just wondering whether this is going to be possible.
But if I may, I'll just pick up on what Juan Luis was saying again, you know, from the front line. Very good point. Something that would scare Americans, you know, for example, and let's be honest, that's the largest and deepest capital market. And entrepreneurs coming from there contemplating European expansion would in fact very much be government competition, right? That would be one of the many factors that has put a bigger risk premium on investments in Europe. In addition, you're talking about, do we have enough startups? You could argue we have too many in Europe. Europe is chronically unconsolidated compared to America across industries. We have too many companies, but too small. That's a controversial statement of the day. The other one is that we are not profitable enough to attract the Americans and the Japanese and the Chinese in the volumes we perhaps would compared to American enterprises. And one of the reasons there is a higher tax burden, for example, on countries. And the last one is just the big macro risk of Europe and European Union breakup and Brexit and Grexit and all those things, which have now been put aside to a large degree. And then we have again now this very consolidated message coming out of Europe. In addition, behind all this, but my last point here, I basically says, yes, I think there is ample opportunity for private equity, local and foreign, to work on consolidating and creating efficiency. And the signals of the remaining bit of the EU after Brexit is that it is actually perhaps arguably stronger. And that's sort of how it's being seen, more harmonious. And the very fact that the way this program or parts of this program, which Christine can help me, is financed by EU communal liability bonds, basically. This is a big taboo that has actually is kind of behind this program, and a big new element, which implies an element of collective, collective fiscal and monetary integration in the EU. And that's actually part of this agenda, which, you know, I guess would support those who are worried that, you know, we're not actually on the same page within the European Union, and I'd rather invest somewhere else. So I think it's all coming in together in the right direction to add confidence.
I fully agree also with what Anya said. So it's true that there is enough dry powder. There is much more coming. The problem is that dry powder is going to very few sectors now. So there are high prices if you are searching for example, education, healthcare, this kind of current sexy sectors, IT. But if you go for automotive industry, for example, there isn't dry powder. So nobody wants this kind of companies these days, and I'm sure that there are great opportunities of value creation there. So yeah, but probably we would have a certain pressure to buy assets. And on top of another idea that I would like to point out, that all these flows of money is coming from the central banks. are going to generate or could generate inflation, which is something that obviously you don't want to have monies at hand with an inflation scenario, which we are not used. Well, I remember we were used to having 10%, 15% inflation rate 25 years ago. But we are not used to on the last year. So again, there is another pressure for buying assets that is going to come for that potential risks, because inflation, governments want to create it because it's easier to pay debt with inflation. Interest rates are not likely to move a lot. So negative cost of money is going to produce a good pressure to buy assets, which is something that would put on another pressure for what you were saying, Anya.
And to answer another question of Anya about startups, I would concur with Klaus that there are enough, if not too many, startups in Europe, but they would definitely need to be to have enough power, enough money, enough support to grow and to become companies of a normal, so to say, normal size, SMEs or small mid caps or mid caps. And this is the missing link, I think. And I think at EIF, among other investors, we are pushing for what we call late stage venture or growth expansion because of that, because I think it's very important to support these companies. And if part of the grants, which are now the subject of today, could go to more fundamental research, that would create probably the startups of within 5-10 years. But in the meanwhile, we should also concentrate at the level of EU to develop these companies, because otherwise it's just a nice shopping mall for companies from China or from the US who buy these tiny companies for a very small amount, take the technology back to their own companies, and in the end there is no value creation for Europe and limited job creation for Europe. So I think this is also a way maybe to organize the financing of these companies with a bit more grants, and then concentrate private equity and private capital in general to grow these companies, the most successful of these ones, to grow them to a size which matters for Europe and matters for their reach worldwide, so to say.
Okay, I think because we are slightly beyond the original time frame, are there any questions from the audience to either of the three participants? Please don't hesitate to ask. Or same actually goes to Isabel and to Jérôme, just in case there were still any questions. No?
Anya, I can see a question on the chat from one of the attendees.
Raise hand. Let me just see what it is. I cannot actually see that. Let me just see chat.
I can read it out. It's,
yes, because I don't see it. Mm-hmm.
So the suggestion is that subsidies and related regulation compliance should be part of due diligence. I guess it's more of a statement than a question. And I think the answer is yes.
The answer is yes. And there is a very interesting growing sector of companies advising these issues. You know, so yes, absolutely.
Okay. So I think that pretty much concludes then this little workshop, which I hope has given a little bit of insight on something which we probably really haven't seen so far put into practice, because it's just starting such a huge program, but that's going to have an impact for the next 30 years, I guess. And I think I'll give back the word to Stefan, who's probably going to say a couple of words.
And also thanks to all our panelists for this very interesting and also passionate exchange. We also agree that early stage and late stage are very important, but also sometimes hear from the market that exactly the intermediate level for the scale-ups is also very important in the future. But we concur with the conclusions that all those interesting technologies and innovations should not just be simply plundered and then nothing comes out of it in the future. That would be really a pity. Thanks again for joining us today for this interesting content, and we're very happy to pursue our collaborations with ASCRI in the future and many other partners. And I just wanted to finish then the session with a quick highlight of what will happen on the LPEA side in the future. So as you may know, we are currently having our LPEA Training Academy. Next week, we will have Cyril de Maria, who is also a private equity expert, author, and also professor, who will propose private equity foundation courses, and certainly also have a new webinar on PropTech, which would also be interesting. And finally, our private equity venture capital Luxembourg stories from ASCRI. So thanks again, and see you very soon.
Thank you.
Very much. All the best. Thank you. Bye-bye.
Bye.
Bye.
Bye.